The obstacles that we can see today must not stop us. These obstacles, in some way, they are even an advantage because this.
What happens when a country long trapped in dependency suddenly attracts one of the Gulf's richest sovereign wealth funds to its side? That's the shock from Ouagadougou, where Oman has stepped in with a three-pillar package: a gold joint venture, a multi-sector partnership, and agricultural investments in rice and strategic crops. For Burkina Faso, it is not just money, it is validation of a new strategy: sovereignty, self-sufficiency, and South-South cooperation. But what is there for Oman in it? Let's find out. The deals, unveiled in the presence of top officials, include a joint venture in gold mining, a multi-sector investment partnership, and agricultural projects centered on rice and strategic crops. The signatories were no small figures. From Oman came Abdul Salam Mohammed Al-Murshidi, chairman of the Oman Investment Authority (OIA), a sovereign wealth fund managing tens of billions of dollars. From Burkina Faso, the agreements were formalized by Karamoko Jean-Marie Traoré, Minister of Foreign Affairs, alongside leaders of SOPAMIB, the state-owned mining participation company, and the Ministry of Agriculture. The symbolism was powerful. A Gulf monarchy known for its oil wealth was planting a new stake in the heart of Africa, not through colonial logic or donor rhetoric, but through shared ownership and partnership. The news reverberated instantly across Africa. In Bamako, commentators asked whether Mali could pursue a similar model with Gulf partners. In Niamey, Nigerians saw parallels with their own break from France over uranium. Across the Sahel, the message was clear. Burkina Faso had just opened a new door, and Oman had walked through it. This wasn't a Western aid mission wrapped in humanitarian slogans. It wasn't a loan scheme from the IMF with strings attached. It was hard capital flowing into Africa's resources, industries, and food security, and doing so under terms negotiated by Africans themselves. For Burkina Faso, the timing could not be more significant. Just months earlier, the government had intensified its push for resource sovereignty, nationalizing parts of its gold sector and demanding that foreign companies refine more of their output locally. These moves rattled Western investors but electrified ordinary Burkinabe citizens who had long seen their gold in rich outsiders while leaving them in poverty. The Oman deal builds directly on that momentum, signaling that when Burkina Faso asserts its sovereignty, it doesn't scare partners away. It attracts new ones who are willing to engage on equal footing. The agreements also come at a moment when the Sahel is undergoing one of the most dramatic geopolitical realignments in modern African history. With France pushed out of Niger, Mali, and Burkina Faso, Western influence is visibly crumbling. In its place, new partnerships are emerging. Russia with Niger's nuclear ambitions, Turkey with Mali's defense industries, and now Oman with Burkina Faso's gold, agriculture, and development. Each deal, though different in sector, carries the same underlying message. Africa is no longer waiting to be told what it can or cannot do. What makes the Ouagadougou signing stand out is the scope. Most foreign agreements in Africa focus narrowly on one sector, usually extraction. This one was broader. Gold, yes, but also agriculture. Agriculture, yes, but also infrastructure and industry. Oman didn't come with a pickaxe and a one-way ticket for raw exports. It came with a willingness to tie itself to Burkina Faso's national priorities, diversifying the economy in a way that acknowledges the full picture of development rather than just its most profitable corner. Western media, of course, was cautious in its coverage, framing the deal as a high-risk move by Oman into an unstable region. But on the streets of Ouagadougou, the perception was entirely different. Crowds celebrated the announcement, waving Burkinabe flags and chanting slogans about sovereignty. For them, this was not about risk. It was about recognition. Recognition that Burkina Faso is not a charity case, but a country with resources, ideas, and the right to negotiate partnerships that serve its people. The symbolism is undeniable. A nation once forced to beg for aid is now signing billion-dollar agreements on its own terms. The very act of seeing Abdul Salam al-Murshidi sitting side by side with Karamoko Jean-Marie Traoré, sealing deals in gold and rice, tells a story of two nations meeting as equals. It also tells a bigger story of Africa's new role in global economics. But why did these agreements begin with gold? Why is it always gold that anchors Africa's struggles and victories? To understand that, we must dive into the heart of Burkina Faso's gold story, a tale of exploitation, resistance, and now, transformation. For decades, Burkina Faso's soil yielded treasure that enriched foreign companies while leaving its people in poverty. Since the 1970s, foreign miners, particularly French, Canadian, and Australian firms, extracted hundreds of tons of ore, yet little of the value stayed in country. Royalties were meager, profits repatriated, and the state itself had almost no say in how mines were run. Villages near mining sites were left with poisoned water, shattered lands, and fragile livelihoods, while corporate headquarters abroad boasted of record dividends. This is the backdrop against which Captain Ibrahim Traoré's government came to power with a pledge of resource sovereignty. In 2023-24, the junta began systematically tightening control over the mining sector, creating SOPAMIB, the Société de Participation Minière du Burkina, to ensure the state had not just a symbolic stake, but a decisive voice in gold operations. Foreign firms were told bluntly, "If you want to keep mining, you will partner with us." Some resisted, some left. But in their place, new partners arrived, and Oman's entry through minerals development Oman MDO is the most striking example yet. The deal with MDO is not a concession. It is a joint venture, a phrase that makes all the difference. In practice, it means the Burkinabe state is no longer a passive tax collector waiting for scraps. It is a co-owner, a shareholder, a participant in management, and a beneficiary of profits. SOPAMIB sits across the table from MDO as an equal, not as a beggar. Decisions on safety standards, environmental management, community engagement, and profit allocation will now involve African voices that were absent for decades. The symbolism is profound. Gold, once the emblem of extraction without benefit, is being rewritten into the emblem of co-ownership. And this is not just paperwork. The government has already begun constructing its first gold refinery, with a capacity to process 400 kilograms per day. Under the new framework, part of the gold extracted with Oman's participation will no longer be exported raw. It will be refined at home, creating jobs, building expertise, and keeping added value within Burkina Faso. This shift has ripple effects beyond economics. For local communities in gold-rich regions like Houndé and Essakane, the state's stronger presence means a better chance at accountability. For young Burkinabe engineers and geologists, it means training opportunities within a joint venture rather than endless subcontracting to foreign experts. And for the state itself, it means a steady stream of revenue to fund projects in infrastructure, defense, and education, areas once starved by the outflow of mining wealth. Western investors predictably have raised alarms. They call it resource nationalism. They warn of instability and capital flight. But these criticisms ring hollow when one considers that for half a century, investment in Africa meant nothing more than pipelines carrying raw ore away from its soil. If that model is destabilized, it is because it deserved to be. Oman's decision to step into this new model is telling. Muscat could have chased safer returns in Europe or Asia. Instead, it chose to back a sovereign African framework, knowing full well that co-ownership means sharing power, not just profits. For Oman, it is a bet on long-term stability and legitimacy. For Burkina Faso, it is validation that its demands for sovereignty do not drive partners away. They attract those who respect them. Yet gold, no matter how well managed, cannot feed a nation. Mines bring revenue, but they do not put food on the table. This is why the second pillar of the Oman deal is so vital: agriculture. If gold secures sovereignty, rice secures survival. And so the story moves from the glittering mines to the green fields, where the fight is not about profits, but about hunger, dignity, and food independence. Let's pause for a second to say, big thank you to the Black Culture Diary community, where Black voices, stories, and legacies are preserved and amplified. By becoming a member, you're not just supporting the channel, you're becoming part of a powerful cultural movement. Let's continue. Gold may fill treasuries, but it cannot fill stomachs. That is why the most revolutionary part of the Ouagadougou agreements may not lie in the mines at all, but in the fields. Alongside the joint venture in gold, Oman pledged to invest in agriculture, focusing on rice cultivation and other strategic crops. At first glance, this might seem less dramatic than gold. But in truth, it strikes at the very core of Africa's dependency trap. Food. Burkina Faso, like much of the Sahel, has lived under the shadow of food insecurity for decades. Despite fertile land and millions of farmers, the country has been forced to import rice and other staples to feed its population. Every time global grain prices spiked, whether from a drought in Asia, a war in Ukraine, or disruptions in shipping lanes, Burkinabe households felt the shock. Riots over food prices in Ouagadougou and Bobo-Dioulasso were not rare. They were warnings that sovereignty in gold meant little without sovereignty in food. The Omani Agreement directly targets this problem. Through its food investment holding company, Muscat will channel capital and expertise into Burkina Faso's agricultural sector. The focus on rice is both symbolic and practical. Rice is not just a staple food, it is the political heartbeat of the nation. When rice is affordable, governments are stable. When rice prices rise, unrest brews. To produce rice domestically at scale is to secure not just food, but legitimacy and social peace. But the agreement goes further than just planting rice. It includes investments in strategic crops, cereals like maize and millet, crops that are resilient to climate pressures and form the backbone of rural diets. By upgrading irrigation systems, supplying mechanization, and supporting processing facilities, the deal seeks to modernize a sector that has long been stuck in subsistence. Imagine Burkinabe farmers using modern harvesters, storage silos reducing post-harvest losses, and local mills turning grain into flour and packaged food ready for domestic markets. That vision is what this partnership gestures toward. The implications ripple beyond food supply. Local rice production reduces the drain of foreign exchange reserves used to import staples. It creates rural jobs that slow the migration of young men into cities where unemployment breeds discontent. It fosters value chains, transporters, processors, and retailers that multiply the economic impact far beyond the fields. And in regional terms, a food-secure Burkina Faso can become a supplier to neighboring countries, shifting from importer to exporter. For Oman, the move makes strategic sense. Investing in agriculture abroad is a hedge against its own vulnerabilities. The Gulf states are acutely aware of how fragile food supply lines can be. Many of them import over 80% of their food. By embedding themselves in African agriculture, they secure future supply options while supporting Africa's push for food sovereignty. For Burkina Faso, this is less about exports to Muscat and more about building the capacity to stand on its own feet. The alignment of interests creates a rare win-win. Africa secures dignity, Oman secures diversification. Western analysts often dismiss agricultural investments as less glamorous than mining or oil. But in reality, agriculture is the foundation of sovereignty. A hungry nation is an unstable nation, no matter how much gold lies beneath its soil. By making rice and strategic crops central to the agreement, Burkina Faso and Oman are acknowledging a truth that aid programs often ignore. Development begins with food security. And yet, farms cannot thrive in isolation. Fields need roads to move crops, storage to protect them, power to process them, and industry to distribute them. This is why the second Omani Agreement, the comprehensive multi-sector investment partnership, may prove just as critical. If gold provides revenue and agriculture provides survival, then industry provides transformation. But what exactly does this broader partnership promise for Burkina Faso's future? Here's a reminder to please like and share the video and subscribe to our channel to watch more videos on Black culture, history, civilization, and identity. Let's continue now. If gold secures sovereignty and rice secures survival, then the third agreement signed in Ouagadougou points to something even bigger: transformation. The comprehensive multi-sector investment partnership between Oman and Burkina Faso is not limited to one commodity or one crop. It stretches across energy, infrastructure, and industry, the arteries of a modern economy. Why does this matter? For decades, Burkina Faso and its neighbors were locked in an economic model designed elsewhere. Colonial administrators and later Western financial institutions told African nations they could extract and export raw materials, but must not dream of industrializing. They were told to specialize in cotton, cocoa, gold, or oil, and in return they would receive aid, loans, and lectures on good governance. The result was painfully clear. Mines that produced wealth but no factories, farms that produced food but no processing industries, and economies that looked outward for validation rather than inward for strength. The Oman Agreement disrupts that cycle. It signals that Ouagadougou does not want to be trapped in extraction alone. It wants investments in energy generation to power its cities and industries. It wants roads and logistics to connect its mines to refineries, its farms to markets, and its people to opportunity. It wants industrial plants that can process raw materials into finished goods rather than shipping them out unrefined. Oman's decision to sign onto such a wide-ranging framework shows confidence in Burkina Faso's trajectory. For Muscat, this is not about short-term gains. It is about embedding itself in an economy that is determined to diversify, expand, and break free from the dependency cycle. This is not a charity project. It is a calculated bet on Africa's rise. The comprehensive nature of the partnership is critical because mining and agriculture alone cannot guarantee long-term prosperity. A gold joint venture might bring millions in royalties, and rice production might stabilize food prices, but without roads, power grids, and industrial plants, these gains cannot translate into transformation. Oman's willingness to fund projects beyond the obvious profit centers demonstrates a recognition that development must be holistic. Consider energy. Burkina Faso has struggled for decades with blackouts, forcing businesses to rely on costly generators. Without reliable electricity, no factory can run at full capacity, no modern hospital can function properly, and no digital economy can emerge. If Oman's capital flows into Burkina Faso's energy infrastructure, whether thermal, hydro, or solar, it would light not just homes but entire industries. Consider manufacturing. For too long, Burkina Faso exported raw cotton while importing finished textiles, exported raw gold while importing finished jewelry, and exported cereals while importing processed food. Each of these cycles drains value from the economy. With industrial investment, those same resources can be transformed domestically, multiplying jobs and keeping wealth within national borders. Critics may say this is ambitious, that a single partnership cannot overturn decades of structural imbalance. They are right. One deal alone cannot do it. But deals like this mark the beginning of a shift. They show that Burkina Faso is no longer content with being told to stay in its lane. They show that investors from outside the Western orbit recognize Africa's industrial potential and are willing to support it. This broader framework also serves a strategic role for Oman. By aligning itself with Burkina Faso's long-term plans, Muscat gains more than just profits. It gains political capital in a region redefining itself. The Alliance of Sahel States AES, formed by Burkina Faso, Mali, and Niger, has made sovereignty and economic independence its rallying cries. By partnering with one of its core members in a broad-based way, Oman embeds itself into that movement. And yet, the question remains, why Oman? Why would a Gulf state thousands of kilometers away take this gamble in the Sahel? The answer lies in Oman's own history and its determination to diversify its economy, not just within its borders but across the globe. To understand this, we must look at Muscat's own strategy of survival. Oman has lived under the shadow of oil dependency for most of its modern history. Like its Gulf neighbors, its state revenues, budgets, and foreign reserves were tied to the rise and fall of crude oil prices. When prices were high, the economy seemed invincible. When they collapsed, deficits mounted and stability wavered. Recognizing the danger of this cycle, Oman created the Oman Investment Authority (OIA) to diversify its wealth and invest in assets that would secure long-term returns. For years, OIA looked toward Europe, North America, and Asia, buying real estate in London, shares in Western corporations, and bonds in developed markets. But that old strategy has its limits. Western economies are slowing, their politics are volatile, and their markets are crowded. The returns are modest, and the influence gained is minimal. Africa, by contrast, offers something that Western markets cannot: untapped potential, young demographics, vast resources, and governments eager to break free from dependency. For Oman, investing in Burkina Faso is not a leap of faith. It is a rational hedge against a world where oil will one day lose its crown. And yet, while Oman is diversifying, Burkina Faso is leveraging. The critical difference between this deal and older Western partnerships is who sets the terms. In the past, France, the IMF, and other outside powers dictated the rules. Privatize your mines, open your markets, cut subsidies, and take loans that ensured dependency. Today, Ouagadougou is saying, if you want our gold, you will partner with SOPAMIB. If you want to invest in our agriculture, you will focus on rice and strategic crops that feed our people. If you want a stake in our future, you will invest not just in mines, but in energy, roads, and industry. Oman accepted those terms because Africa today has the leverage to demand them. This is the deeper meaning of the Ouagadougou agreements. They are not just about gold, rice, or industry. They are about a power shift. Africa is no longer the passive quarry of the world. It is the arena where global players compete for access, and where African leaders increasingly shape the rules of engagement. For Oman, this gamble yields both returns and respect. By investing in Burkina Faso under its sovereignty-first framework, Muscat gains a foothold in a region that is redefining its alliances. It signals to other Gulf states that Africa is open for partnerships built on equality rather than exploitation. And it positions Oman not just as a follower of Western models, but as an innovator of South-South cooperation. For Burkina Faso, the leverage goes beyond economics. These agreements serve as proof to its people that the government's sovereignty agenda can attract partners rather than repel them. It strengthens domestic legitimacy at a time when the alliance of Sahel states is fighting for recognition and independence. And it sets a precedent for other African nations. Sovereignty does not mean isolation. It means negotiating from strength, demanding fair terms, and walking away from those who refuse to offer them. This moment also raises the bigger continental question. If Oman is willing to accept co-ownership in gold, food-focused agriculture, and multi-sector investment, what happens when Africa brings similar terms to other partners? Will Saudi Arabia, the UAE, and Qatar follow Muscat's example? Will China, already Africa's largest trading partner, adjust its approach to meet the new standard of sovereignty-first deals? And will Western powers, long accustomed to dictating terms, finally recognize that the balance of power has shifted? The story that began in Ouagadougou with 3 agreements is part of a much larger story, Africa's awakening. From Niger's nuclear dreams to Mali's defiance of foreign miners, from Ethiopia's industrial push to Burkina Faso's rice revolution, a new pattern is emerging. Africa is not waiting to be told what it can do. It is telling the world what it will do. And so we return to the central question. What happens when a Gulf monarchy famous for oil plants its future in African soil? The answer is that both sides gain, but Africa gains something more valuable than money. It gains recognition, leverage, and the right to define its destiny. The Oman-Burkina Faso agreements are more than contracts. They are a declaration that the age of dependency is ending, and the age of African partnership has begun. Do you think Burkina Faso's gold will finally enrich its people instead of outsiders? Let us know in the comments section. Can food sovereignty through rice farming really end Africa's dependency on imports? Do you want to watch more videos like this one? If so, subscribe to our channel and press the bell icon next to it. We have decided to bring videos on something nobody talks about: the Black culture, civilization, history, and evidence about how glorious Blacks have been. Thanks for watching, and until the next video, stay tuned.